Imagine trying to pick the best single tree in an enormous forest. Now, imagine buying a tiny piece of the whole forest instead. That is the basic idea behind an index fund. It is one of the simplest tools in investing, but simple does not mean risk-free. For many beginners, investing feels like a game where you have to guess the next winning company. Index funds offer a different approach. Instead of trying to outsmart the market, they let you own a broad slice of it. An index fund is an investment fund that tries to track a market index. A market index is a list of investments chosen to represent part of a market. For example, an index might represent large United States companies, small companies, bonds, or international stocks. Think of an index like a scoreboard. It does not usually buy or sell anything by itself. It measures how a group of investments is doing. If the companies in the index rise in value, the index rises. If they fall, the index falls. An index fund is different from the index itself. The index is the recipe. The fund is the actual meal. The fund buys investments in a way that is designed to closely match the recipe. Suppose an index contains 5 companies. If one company makes up 40% of the index, the fund may try to put about 40% of its stock money into that company. If another company is only 5% of the index, the fund may hold a much smaller amount. Many well-known stock indexes are weighted by market value. That means bigger companies usually take up more space in the index. If a company becomes more valuable compared with others, it can become a larger part of the index. Index funds are not all the same. Some track broad stock markets, some track specific sectors, some track bonds, some focus on one country, while others spread across many countries. The name index fund describes the method, not one exact investment. Index funds are often connected with passive investing. Passive does not mean nothing happens. It means the fund is not trying to constantly pick winners and losers. Its main job is to follow the chosen index as closely as practical. An actively managed fund pays managers to choose investments they believe will perform better. An index fund usually follows a fixed set of rules. The active fund is trying to beat the market. The index fund is trying to match a chosen part of the market. One reason index funds became popular is cost. If a fund does not need a large team making constant predictions, it can often charge lower fees. Lower fees do not guarantee better returns, but they do mean less money is taken out along the way. Fees can feel small because they're usually shown as percentages, but investing is a long-term activity, and small percentage differences can matter over many years. A lower-cost fund leaves more of the investment return inside the account. If this kind of clear finance explanation is useful, consider subscribing. The goal here is not hype or quick tips. It is to make money concepts feel understandable enough that you can ask better questions and make more informed decisions. Another major idea behind index funds is diversification. Instead of depending on one company, an index fund may hold dozens, hundreds, or even thousands of investments. If one company struggles, it is only one piece of the bigger basket. Diversification can reduce company-specific risk, but it cannot remove all risk. If the entire stock market falls, a broad stock index fund can fall too. Owning many stocks does not protect you from every kind of market decline. Index funds can be low effort because they do not require you to research every company. But low effort does not mean safe in every situation. The value can rise and fall, sometimes sharply, especially for stock index funds. When you buy shares of an index fund, you do not own the index directly. You own shares of a fund. That fund owns investments, such as stocks or bonds, according to its rules. Your return comes from how those underlying investments perform, minus costs and other fund effects. Index funds can come in different wrappers. Some are mutual funds, some are exchange-traded funds, often called ETFs. Both can track indexes, but they trade differently and may have different account rules, costs, and tax details. With many index mutual funds, purchases happen at the end of the trading day at the fund price. With ETFs, shares trade on an exchange during the day, more like a stock. The core idea can still be the same. The fund is trying to track an index. Indexes change over time. Companies may be added or removed. Bond indexes may shift as bonds mature and new bonds appear. The index fund has to adjust its holdings so it can continue following the index. Tracking error is the gap between the fund's performance and the index's performance. A fund may not match perfectly because of fees, trading costs, timing, cash holdings, or practical limits in buying every investment in the exact index weight. Imagine trying to copy a painting while the original is still being changed. The fund is trying to follow the index, but markets move constantly. Even a well-run index fund can have small differences from the index it tracks. Some index funds use full replication. That means they try to hold every investment in the index in the same approximate weights. This can work well for indexes with a manageable number of liquid investments. Other funds use sampling. That means they hold a representative selection instead of every single investment. This can be useful when an index has many hard-to-trade holdings, but it may also increase the chance of performance differences. The most important question is not just whether a fund is an index fund. It is what index the fund tracks. A broad market index fund and a narrow sector index fund can have very different risks, even if both are passive. A broad stock index fund may spread money across many industries. A narrow index fund might focus only on technology, energy, real estate, or another segment. The narrower the index, the more concentrated the risk can become. Stock index funds are built around ownership in companies. They can grow when businesses become more valuable and investors are willing to pay more for them. They can also fall when earnings, expectations, interest rates, or market confidence move against them. Bond index funds are different. They usually hold loans issued by governments, companies, or other borrowers. They can provide income, but their prices can still move, especially when interest rates change or credit risk changes. International index funds can give exposure to companies outside your home country. That can increase diversification, but it can also add currency movements, different market rules, and different economic risks. Some people assume an index fund is automatically balanced. That is not always true. If an index is weighted by market value, the biggest companies can dominate it. A fund may hold many names, but still be heavily influenced by a small group of large companies. A common mistake is buying an index fund only because it recently did well. Recent performance can reflect a specific period, a hot sector, or a lucky timing window. It does not tell you what will happen next. An index fund usually aims to capture the return of its chosen market segment, before and after fund costs. That means it will not usually beat that index by a wide margin. The trade-off is that it also avoids relying on one manager's ability to make the right calls again and again. Getting the market average may sound unimpressive, but it can be powerful because many investors struggle to consistently beat the market after costs. Index investing accepts that uncertainty and focuses on broad exposure, low costs, and discipline. Index funds are often discussed in long-term investing, but the time horizon matters. Money needed soon may not belong in a volatile stock fund. If the market drops right before you need the cash, the simplicity of the fund will not prevent losses. Two people can own the same index fund and react very differently. One may stay calm during a downturn. Another may panic and sell at a bad time. The investment is only part of the plan. Your behavior matters too. Index funds are tools, not a complete plan by themselves. A portfolio might include stock index funds, bond index funds, cash, or other assets, depending on goals, time horizon, and risk tolerance. The mix can matter more than the label on one fund. Taxes can also matter. Some index funds may distribute dividends, interest, or capital gains. The impact depends on the account type and local tax rules. This is one reason investors often pay attention to where different funds are held. Before choosing any fund, it helps to read the basics. Look for the index it tracks, the expense ratio, the holdings, the past tracking difference, and any trading costs or account minimums. The goal is to understand what you are actually buying. The expense ratio is the ongoing annual cost of running the fund, shown as a percentage of assets. It is not the only cost, but it is one of the easiest to compare. A lower expense ratio means a smaller drag from fund fees. For ETFs, trading details can matter too. The market price can be slightly different from the value of the underlying holdings. There may also be a bid-ask spread, which is the gap between what buyers offer and sellers ask. Index funds do not remove uncertainty. They do not promise profit. They do not choose the perfect time to buy or sell. They simply offer a rules-based way to own a selected market segment, usually with broad diversification and relatively low effort. Index funds can disappoint when investors misunderstand them. A risky index can still be risky. A cheap fund can still lose value. A popular fund can still be poorly matched to your goals. The fund has to fit the purpose. The clearest way to think about an index fund is this. It is a fund designed to follow a chosen market index. Its strengths are simplicity, diversification, and cost efficiency. Its weakness is that it follows the market down as well as up. Instead of asking which stock will win, an index investor asks which market segment they want exposure to, what risk they can handle, and how long the money can stay invested. That shift is what makes index funds so important to understand. If you still have questions about index funds, leave them in the comments. You can also suggest the next finance topic you want explained in plain English. Your question might become the starting point for a future video.